An unsecured card sounds safer, but the unsecured part confuses most people. An unsecured credit card simply means you don't put down a deposit as collateral. That doesn't mean the debt is optional. You always owe whatever you charge. And it doesn't protect your credit either. Late payments still get reported and can drop your score, just like with a secured card. Approval mostly comes down to underwriting, meaning the bank judging your risk, not the label unsecured. Because there's no collateral, lenders often price in more risk with higher APRs, and fees can still apply. Unsecured cards are approved with your financial profile, not with cash up front. The bank leans heavily on credit bureau data, your history with payments, balances, and past accounts, to decide yes or no. They'll also look at income and debt because that predicts whether you can pay. Many people start with a lower limit, then earn increases after a few on-time months. APR is basically risk pricing, so weaker profiles get higher APR offers. And one missed due date can hit hard with fees, interest, and credit damage. The clearest way to understand unsecured cards is to compare them to secured cards. Secured cards require collateral, usually a refundable deposit, so approval is often easier if your credit file is thin or damaged. With secured cards, the limit is typically tied to your deposit, while unsecured limits come from underwriting and can grow faster. Many secured cards graduate to unsecured after about 6 to 18 months of good behavior. That deposit is usually held separately, often in an FDIC insured account, and returned when you close or graduate. The APR range can still be similar, so the deposit doesn't automatically mean cheaper borrowing. Choosing unsecured versus secured is really about your starting point and your habits. If you already have established credit, unsecured usually makes sense because you don't have to lock up cash. If you have a thin file or recent late payments, a secured card can be a practical way back in since the approval bar is lower. If you pay in full every month, unsecured cards can work well because you avoid interest and keep flexibility. And if you want rewards, unsecured options are far more common. If you don't have stable income yet, it's smarter to wait than to force it. The biggest risk with an unsecured card isn't the lack of a deposit. It's using it like a loan. Minimum payments feel manageable, but on a $3,000 balance at 24% APR, you can pay hundreds in interest over a year. Once you carry a balance, you may lose the grace period, meaning new purchases start accruing interest faster. Your utilization can also spike without you noticing, and that can drag down your score. Late fees stack up quickly, and a penalty APR can kick in after missed payments. Most of all, your limit is not extra income. It's a borrowing ceiling. If you carry a balance, you can lose your grace period and start paying interest on new purchases. CreditCardAgent matches you to cards based on how you actually spend and shows the real dollar impact versus your current card. Free, about 3 minutes, no login or credit check. Links in the description.